Hey everyone, I'm Tim Wills and welcome back to my channel. Traditionally, funds charge a commission, which is a set fee for every single transaction that a customer performs using their service. Usually they're tiered, so the more you're trading, the higher the fee was. And this is fair. If you're using their service, you should have to pay for it. But in recent years, we've seen the rise of commission-free trading, with Robinhood pioneering the idea and plenty of others following suit. But just because something looks free on the surface doesn't mean that it's always the case, and in this particular case, it's far from it. Now, Robinhood did pioneer the idea, but there are tons of other trading platforms that also use this business model, like for example Sharesies in New Zealand, which has just switched over to being entirely free for the customer to use. Ever heard the phrase too good to be true? Well, this is a classic example of that. Robinhood say on their website that they don't charge fees to open your account, maintain your account, or transfer funds to and from your account, but very sneakily, nowhere on their website will you find the phrase they don't charge fees to buy and sell shares. Robinhood, after all, is a business and they need to make money. They just disguise it behind this commission-free banner. Before I go any further, I want to point out that I have absolutely nothing against companies like Robinhood offering this commission-free trading as a business model. I think it's a really great idea that has removed the little barrier to entry that was probably holding back a lot of people from investing $50 or $100 every week or month from their paycheck. So it's awesome, and it's probably the single greatest contributing factor towards the massive rise in retail investing. With that said, let's get back to how they actually make money. In investing, there's something called a spread. It's the difference between the bid price, which is how much buyers are willing to pay, and the ask price, which is how much sellers are willing to sell their stock for. Typically, people selling the stock will want more than people buying the stock are willing to pay, but the difference is often tiny. And this tiny difference is what causes the bid-ask spread. Now, there is a profit to be made in this little bid-ask spread, and that's where a market maker comes in. They act as a middleman between the buyers and the sellers, and their profit is the size of the spread. Market makers can be individuals, but are far more commonly brokerage firms that you've likely never heard of. The largest market maker at the New York Stock Exchange is a firm called Global Trading Systems LLC, and they're responsible for $12.5 trillion of market capitalization. For a large company whose stocks are being traded very frequently, the bid-ask spread is going to be really small. For example, Apple has a bid-ask spread of between 4 and 6 cents, which works out to be less than half a tenth of a percent. And this can essentially be thought of as the fee charged by the market maker to you. It's how much you are paying to use their service, and as you can probably tell, if you're only investing $50 to $100 every week, that amount is negligible. It's barely anything. Unfortunately, that's not the only cost you incur. You also have to pay the indirect cost of a market inefficiency that we'll talk about soon. But first, let's talk about how Robinhood actually makes money, because Robinhood are not a market maker. They're just connecting you with the market makers. The way Robinhood makes money is through affiliate commissions. See, the market makers are willing to pay a percentage of their profits to Robinhood for bringing customers to them. So when you go on Robinhood to buy a stock, you are connected with the best available market maker. You'll understand why I did that soon. And they sell you whatever stock you're wanting. They take a tiny profit for themselves, and they give an even smaller commission to Robinhood. On average, Robinhood will receive 0.17 cents for every share they refer to a market maker. That means you'd have to do 5 buy or sells for them to make 1 cent. It's not a lot, it's tiny, so they rely on huge volumes to make a profit. So what's that market inefficiency that I was talking about before? See, when brokers charged a commission, they would often promise the best possible price execution, prioritizing price security, so when you placed an order, you were promised the best possible price at that time. Robinhood, on the other hand, is looking for the cheapest option, so the best possible price is not prioritized, and often when you buy a stock through them, you're not given the best possible price. This difference is negligible when trading in small quantities, and you're often better off going the commission-free trading route than paying like a $10 commission to get that price security. But when you're trading larger amounts, the spread starts to play a much larger role in the total cost of the transaction. Hence, big money investors will typically stick to paying a fixed commission to guarantee they get the best possible price. To put that into an example, let's say you're wanting to buy 1 share of ABC company, and currently the best possible ask price is $100, and you're buying it through a broker who does charge a commission. So you pay a $10 commission and you're able to buy the share at the best possible price, which is $100. On the other hand, if you bought that through a commission-free trading platform like Robinhood, they don't prioritize price security, so they might match you with a market maker who is selling the same share for $102. Now, you don't have to pay a commission on that, but you do have to pay a slightly higher price for each stock. You can see when we're only buying one share, it makes a whole lot more sense to buy it through a commission-free trading platform and pay a slightly higher price for the stock. But if we were to buy 100 shares, it would make a lot more sense to pay the $10 commission and guarantee the best possible price. There is another flaw in the commission-free trading business model, and that is it prioritizes options. Robinhood gets paid on average 58 cents per 100 option shares traded on their platform, compared to 17 cents per 100 equity shares traded. So it makes sense that Robinhood would prefer you to trade options because it's going to make them more money. The reason options contracts pay more is because they are traded less frequently, therefore the spread, the difference between the bid and the ask price, is higher, and market makers can make a larger profit. The problem is options are really complicated trades that allow the client to buy or sell securities at a predetermined price in the future. Options are typically used by professional traders or hedge funds. They're very speculative, and if you don't have an extremely good idea of how they work, you will likely lose money. So you can sort of see where this is going. Robinhood is predominantly filled with beginner to medium level investors, but their highest profit margin product are options, which is exactly what Robinhood investors should not be touching. It creates a real conflict of interest because Robinhood are trying to push these option trades because they make more profit for them, but it also is really bad for the investor because they're probably going to lose money on it. So if you do see Robinhood or another commission-free trading platform trying to push you to buy options contracts, don't buy them because you'll only lose money in the long run. So Robinhood makes money by referring you to a market maker who in turn gives them a small kickback for the business they received. There are a few conflicts of interest in this business model, but in general, it's a great thing for investors who are wanting to invest just a small amount each week or month. It's removed the barrier to entry that was really off-putting to part-time investors in the past. However, if you're wanting to invest larger amounts, it's probably best to look for other options than commission-free trading, because commission-free trading is definitely not free. Thank you so much for watching this video. If you liked it, please remember to smash the like button and subscribe. I post finance-related videos like this every week, so I'll see you back here next time.